These are all baseline things that all real estate investors need to know so they can do their due diligence and make sure they don't screw up. Because hey, some of the things you need to know in real estate are the simple things. The complicated stuff will come as you get into it. So let me show you. All the money in real estate is made on the buy. If you're buying rentals, one of the easiest ones is the 2% rule. It almost always works. So it's quite simple. It's the 2% rule. If you were to pay $200,000 for a property, you should always take 2% of the purchase price as your rental. So if you paid $200,000 for a property, you got to be collecting $4,000 a month in rent. Now, when you look at that, you can also reverse engineer that. You could look at a property and you could say, how much are the rents? And you could figure out the rents. Let's just say they're $4,000 a month. And then you could say, all right, well, at $4,000 a month, I can pay up to $200,000 for this property. Now, here's a couple things, too, that some investors do, and there's not a right or a wrong way to do this. They will buy a property. Let's just say rents are $3,000 a month right now. But they see that the rents are undervalued. Maybe the existing owner hasn't been raising rents. They're just friends with the tenants. They don't want to upset the current ebb and flow. So you might come in and say, you know what? I can increase rents to $4,000 through capital improvements. I'm going to make the units nicer. I'm going to let these tenants move on, and I'm going to bring in new tenants after I renovate. There's a lot of ways that this can be done. So if you were to buy the property and it had $3,000 a month in rent, but you knew that the seller wasn't going to sell it for the multiple of 2%, you could then do a pro forma and figure out, well, if I get the rents from $3,000 to $4,000, now I can pay $200,000 for it. So you can see how this can be really helpful. You can start with the purchase price and then back into the rents and figure out, can I get rents to be this? And if not, then just walk away from the deal, because then it's not going to be as solid of a deal. Now, I do want to give you one thing that in today's environment, this is 2021, the markets are pretty high. Real estate markets are, I would say, very speculative and at an all-time high. So this rule might make it so that you can't always find properties, but this is where you need to draw the line. Any investor has rules, and you must follow your own rules. If you don't, if you violate your rules, you're speculating. You're entering no man's land, and there's a good chance you're probably not going to have the success you want. I mean, you could even lose money, but here's something some investors do. They will use a 1% rule. So instead of going off of 2%, they'll use 1% for that number, but then what they'll do is they know that they can increase these rents. So however you do it, I don't particularly like the 1%. If I'm doing a deal, I'm following the 2% rule, and if it doesn't work for that, and I don't think I can get the rents to make sense for the purchase price, sometimes the most powerful thing for any investor is the ability to say no, so that then that investor or you can say yes to the right deal. Because if you go out there and say yes to all deals and make them work and don't follow your rules, you're setting yourself up for failure. Because then when the right deal comes across that does meet the 2% rule, you can't buy it because you just exhausted all of your funds and all of your capital on the wrong deal. So learn what deals to say no to and what deals to say yes to by following simple rules. And that 2% rule is a solid one for rentals. And the next rule is the 50% rule. And the 50% rule kind of goes right in line with the 2% rule, because it says if your gross rents, like the prior example, are $4,000 a month, how much of those rents should be going to expenses? And it should never exceed 50%. So in other words, if you got gross rents of $4,000, the ideal expenses should be $2,000 a month or less. So when you're looking at a property, obviously we figured out everything else out based on the first rule, the 2% rule. Now this one's just as important because, hey, listen, the 2% rule is great all in itself, but if you're making $4,000 and you're spending $3,800 of it in expenses, you've sort of just walked yourself off a cliff, to be quite honest. This is just as important because it's not what you make, it's what you keep. Isn't that what matters? I don't care how much money you make. I don't care how much money your property does. I love the real estate investors that brag about, oh, we bring in X amount of rent. I'm always thinking, oh, that's awesome. How much you keep it? It's not what you make, it's what you keep. And if you don't have rules to understand how much to keep, you're making a big mistake and you're giving up too much money. So let's talk about how much money you get to keep by just following this rule. So the other thing too that I love about the 50% rule is we have some control over the expenses. When we analyze a property and you analyze a property, you're going to look at the expenses and you might look at it and say, you know what? I can cut back on that. You know what? I can try to, do some of this work myself. If you're not scaling and you have time available, maybe you can mow the lawn. Maybe you can do some of the repairs. Maybe you don't need a property manager because the prior seller of the property, the old owner, maybe they hired out property management and lost 10% to that. Maybe they paid somebody to mow the lawn. Maybe you can do that. Maybe they paid for maintenance and maybe you're just a handyman. So the cool thing about the expenses are you have some control to go in and chop this number down. So when you do your pro forma, which we already started for the first one, let's look at the current expenses on the properties that you're buying, and then let's figure out, are these correct? Are they going to be more? Because in some cases, you might be on the other side. The prior owner maybe managed it themselves, mowed the lawn themselves, took care of all the pests and the rodents and everything else themselves, and maybe you're like, man, I don't want to do that. You might have to hire all this stuff out. Make sure that you figure out expenses based on your operations, not the prior owners. The prior owner might have been spending more or might have been spending less than you will when you buy the property. So it's important that you create the pro forma based on how you're going to manage your properties. So this 50% rule is a very important one because again, and I know this is repeating, it's not what you make, it's what you get to keep that really matters at the end of the day. All right, and I love this rule. It's a rule that I used so much, but it's also a rule that I've broken. Breaking this rule has cost me a lot of money, so I no longer break this rule. And it has usually resulted in me either breaking even or losing. So let's discuss the 70% rule. It's quite simple. First thing, this is the max amount you should ever pay for a property. All investors have rules. We've been talking about rules, the 2%, the 50%, and now the 70% rule. So what this basically just says is if your ARV, and just in case you don't know, ARV means after rehab value. So after you do all the work to the property, what will your property be worth? And to figure this number out, it's easy. You could have an appraiser come in and do an as-complete appraisal, or you could just look at comps to figure out what are properties in this area selling for that are all renovated like mine will be. And what you do is you take the ARV times 70%. Very simple math. You could do this in a second, which would give you $140,000. But then if you've got to put repairs or renovations into the property, you have to subtract those out to figure out what your max offer. So let's just assume that this property, to make it worth $200,000, is going to need roughly $40,000 in rehab. So we would take the 140 minus the $40,000 renovations, and that would give us a $100,000 max offer that you should pay for that property. So you sometimes will make a couple mistakes because I've made them. I've made these mistakes numerous times. What those mistakes typically are is overinflating your ARV based on speculation. You might say, oh, if we do this or we do that, our property is going to be worth this much more than all the comps, or this much more than the as-complete appraisal. They don't know what they're talking about. I know that if I put in real wood floors and white shaker cabinets, it's going to make my property worth not 200 like everything else. My property is going to be worth 230. That is a mistake. Okay? The other mistake people make, and this is more common, oh yeah, rehab. They go in with their little piece of paper and they start penciling out, all right, kitchen, 30,000. They go through and they put all the numbers in, but they don't have any basis. They didn't check on material costs. They didn't call a contractor and meet them over to say, hey, how much will it cost to renovate this kitchen? How much will it cost to do that bathroom and to rip that wall down? A lot of people just guess, and then all of a sudden they come up with a renovation of 40,000, but really, when they're done, that renovation was 60,000. So that right there is a huge mistake. You see, in real estate, you got to take some time and you got to do your due diligence, which means bring in professionals, bring in specialists that do kitchens, specialists that do bathrooms, specialists that do flooring and painting. Don't just bring in a general handyman because your job will probably never get done. Or like me, I bring in handyman and then all of a sudden I'm doing the job twice at double the cost. Do you want to pay double or do you just want to do it right the first time? The first one might cost a little more and it might sticker shock you, but it's usually going to be the best place to go. The best way to do it is if you're figuring out renovations, get 3 quotes. But don't make the 2 mistakes of overinflating your ARV. ARV is determined one of 2 ways. By comps, okay, comparable sales. Make sure you find an expert, a realtor, or somebody that really knows how to do that. Or second, which I prefer, get an appraisal. And tell the appraiser I want an as complete appraisal, which means after I do all this work based on this scope of work, how much will my property be worth? Well, your as complete might come in and you thought it was worth $230, but they might say it's worth $200. Then you got to decide, are you right or is the appraiser who does this for a living right? You guessed it. So do not violate the 70% rule. If you follow these 3 rules, your chance of success in real estate will be drastically improved and you'll have a much better experience because, hey, in this business, we all want to make money, so just follow the rules and you'll have a better chance of doing that. So I got one more for you. How about this? I like giving stuff away for free. The act of giving is the most powerful thing. Remember this 70% formula? For some of you, that might have seemed confusing. So what if you actually had a template that just did all this for you with literally like 30 seconds of work? Wouldn't that be awesome if you had that? Well, we did create it. So if you want the max offer formula for free, go into the description either up or down and click the link and we'll send you the max offer formula, no strings attached, but that will help you and that helps us because we are giving and that's all that matters. If you really liked this, check out this video. So what we're going to talk about today are the 5 things you shouldn't be doing with that paycheck, that money you make, that bonus. Whatever it is, I'm going to teach you the 5 things not to do with your money. Let me show you.